People panic, people sell. Then the market recovers and they wish they'd done nothing. Collins explains why this always happens and how to stop yourself. In October of 1987, the stock market fell over 20% in a single day. In 2008, markets fell nearly 50% over several months as the global financial system appeared to be collapsing. In March of 2020, as a global pandemic shut down the entire world economy in real time, markets fell over 30% in a matter of weeks. Every single time the headlines screamed catastrophe. Every single time a significant number of investors panicked and sold everything, certain that this time was different, that this crash would be the one that never recovered. And every single time, without exception, across nearly a century of recorded market history, the market eventually recovered and went on to reach new highs. In this video, we are walking through every major crash in modern market history, what actually happened in each case, and the lesson J.L. Collins says applies identically to all of them. Let's start with the most severe example in modern history, the 1929 crash and the Great Depression that followed. The stock market lost roughly 89% of its value from peak to trough over approximately 3 years, and the broader economic depression that followed lasted most of the 1930s. This was, by any measure, the most catastrophic market decline in modern American history. And yet, investors who held through the entire period and continued participating in the market eventually saw a full recovery, though it took until the mid-1950s for the market to definitively surpass its 1929 peak in nominal terms, a genuinely long and difficult recovery period that should not be minimized. This example matters because it represents the worst-case historical scenario, and even in this most extreme case, the market did eventually recover fully. It is also a reminder of why diversification across time, through consistent ongoing contributions, rather than a single lump sum at a market peak, matters so much. Move forward to October 1987, Black Monday, as it became known. The Dow Jones Industrial Average fell over 22% in a single trading day, the largest one-day percentage decline in market history at that time. The cause remains debated among economists, with factors including program trading and market structure issues frequently cited. In the moment, this felt like the beginning of another 1929-style catastrophe. Instead, the market recovered relatively quickly by historical standards, regaining its losses within about 2 years. Investors who panicked and sold during the crash itself missed this recovery entirely. Investors who held steady or who had the discipline to continue buying during the panic were rewarded substantially as the recovery unfolded. The dot-com crash of 2000 to 2002 saw technology-heavy indexes fall dramatically, with some individual technology stocks losing the vast majority of their value as speculative internet company valuations collapsed back to more reasonable levels. The broader market also declined significantly during this period, though less severely than the technology sector specifically. The recovery from this crash took several years for broader market indexes and considerably longer for technology-heavy indexes specifically, given how extreme the prior speculative valuations had become. This crash offers an important nuance, broad diversification, as you get with a total market index fund like VTSX, meaningfully reduce the damage compared to being concentrated specifically in speculative technology stocks, which is exactly the kind of diversification benefit Collins emphasizes throughout his book. The 2008 global financial crisis remains, for most people alive today, the most viscerally memorable market crash, triggered by a collapse in the US housing market and the resulting failure or near failure of major financial institutions. The stock market fell approximately 50% from its 2007 peak to its 2009 trough. This was genuinely terrifying. Major banks failed, credit markets froze, and there was real, justified uncertainty about the stability of the global financial system itself. And yet, the market recovery that followed was substantial. Investors who continued investing through 2008 and 2009, buying at depressed prices during the depths of the panic, were positioned extremely well for the strong recovery and subsequent bull market that followed over the following decade. Collins describes this period, in hindsight, as one of the best buying opportunities of his investing lifetime. Not because he predicted the recovery's exact timing, but because he simply continued his consistent strategy rather than reacting to the fear in the headlines. In early 2020, as the COVID-19 pandemic spread globally and governments around the world implemented unprecedented economic shutdowns, markets fell over 30% in a matter of approximately 5 weeks, one of the fastest declines in market history. The uncertainty was profound. Nobody knew how long shutdowns would last, how severe the economic damage would ultimately be, or what the path forward looked like. And yet, this crash also offers the fastest recovery on this entire list. Markets regained their pre-crash levels within several months, driven by unprecedented government and central bank intervention combined with markets pricing in an eventual economic reopening. Investors who panicked and sold in March 2020 frequently missed one of the sharpest recoveries in market history, which occurred remarkably quickly after the initial panic. More recently, 2022 saw a significant market decline driven primarily by rapidly rising inflation and the aggressive interest rate increases central banks implemented in response. This crash had a different underlying cause than the prior examples. Not a financial crisis or a pandemic, but a shift in monetary policy and economic conditions. The market decline was significant, and the recovery pattern, while different in its specific timing and shape from prior examples, ultimately followed the same broader historical pattern. A difficult period followed eventually by recovery and new market highs. Here is what should stand out as you look across all of these examples together. The causes were completely different in each case. Speculative excess, a single catastrophic trading day, a technology valuation bubble, a global financial system collapse, a global pandemic, and a monetary policy shift. Despite this variety of causes, the pattern of outcome was remarkably consistent. A sharp, frightening decline followed eventually by a full recovery and new market highs. This consistency across such different underlying causes is precisely why Collins argues that you do not need to correctly predict the next crash's specific cause or timing in order to invest successfully. You simply need to understand and internalize the historical pattern. Declines have always been followed by recoveries, and the investors who benefited most were consistently the ones who stayed invested throughout, rather than the ones who tried to predict and avoid the decline by selling and attempting to time the return. So, when the next crash inevitably arrives, and it will at some unknown future point, for some unknown future reason, here is Collins' practical checklist. Do not sell your existing holdings. Continue your regular automatic investment contributions exactly as scheduled, without pausing them. Avoid checking your portfolio balance excessively, since frequent checking during a downturn only amplifies anxiety without providing any useful new information. Remind yourself of the historical pattern we just walked through across nearly a century of market history, and if you have available cash beyond your emergency fund and a stable income, consider that lower prices during a downturn mean your ongoing contributions are purchasing more shares than they would at recent higher prices. The crash itself throughout history has never been the real danger to a long-term investor's wealth. The danger has always been the panic-driven decision to sell during the crash, converting what would have been a temporary paper loss into a permanent realized loss. Understanding this history is not about predicting the next crash. Nobody can do that reliably. It is about building the conviction to do nothing, or even to continue buying when every instinct and every headline is telling you to sell. Next week, we shift to the final piece of the investment engine, bonds, and exactly when and why Colin says to add them to your portfolio to make this entire process even easier to live through. Subscribe now, and I will see you next week.